Paying off your house early sounds like one of the safest financial decisions a family can make. And sometimes it really is. If you have a $400,000 mortgage at 6.5%, and you add just $1,000 a month toward principal, you can cut a 30-year mortgage down to roughly 15 years and save close to $290,000 in interest. That sounds like a win. No mortgage payment, less money going to the bank, a paid-off house before retirement. So why would anyone question it? Because that calculation only shows one side of the decision. It shows the interest you save. But it does not show the emergency fund you never built, the 401k match you may have missed, the retirement account that grew more slowly, or the home repair that still has to be paid with real cash. A paid-off house can make you feel safe. But if every extra dollar goes into the walls of the house, you can become house. Rich and cash poor, wealthier on paper, but weaker in real life. Today, we're going to look at 5 reasons why paying off your mortgage early is not always the safest retirement move. Not because paying off your house is bad, but because the order matters. And we'll start with 2 men. Their names are Richard and Brian. Both live in similar suburbs. Both have similar families, similar incomes, and almost the same mortgage. Both owe about $400,000 on their homes. Both are paying roughly $2,530 a month in principal and interest alone. That does not include property taxes. It does not include homeowners insurance. It does not include repairs. It is just the loan. And both families get the same opportunity, an extra $1,000 a month. Richard says, "We're going to put that $1,000 toward the mortgage. I want this house paid off early." Brian says, "I want the house paid off too, but first I want to know what this money is supposed to protect." Both of them sound reasonable. And that is why this decision is harder than it looks. Reason 1, AT 6.5%. Paying extra really can look powerful. Let's be honest. If your mortgage rate is 6.5%, wanting to pay it down faster is not stupid. Suppose Richard adds an extra $1,000 a month toward principal on a $400,000 mortgage at 6.5%. What happens? Instead of paying for 30 years, he can pay off the house in about 14 to 15 years. And instead of paying the bank around $510,000 in interest over the life of the loan, he can cut that interest down to roughly $222,000. That is about $288,000 in interest savings. That is not philosophy. That is real money. And if you are watching this and thinking, so why are we even debating this? Richard is right. I understand. On paper, it looks like a clear victory. He gets out of debt almost twice as fast. He saves hundreds of thousands of dollars in interest. He gets closer to retirement without a mortgage payment. But now comes the second layer. Over those 14 or 15 years, Richard did not just send extra money to the mortgage. He sent roughly $180,000 of live cash flow into the house. $1,000 a month, 12 months a year, for about 15 years. And the most important question is not only how much interest he saved. The real question is, what did that $180,000 no longer do for his family? It did not become an emergency fund. It did not capture a 401k match. It did not grow inside a retirement account. It was not available when the roof started leaking. It became home equity. And home equity is wealth, but it is not always protection. Reason 2. Home equity is wealth, but it is not cash. After 5 years, Richard looks disciplined. His mortgage balance is dropping fast. If he had only followed the normal schedule, his balance would be around $374,000. But because of the extra payments, he is now closer to $304,000. That is a real difference. About $70,000 of debt has disappeared faster than it would have otherwise. On paper, Richard is richer, but in his savings account, he has only $11,000. Why? Because almost every free dollar went into the mortgage. And then, ordinary homeowner life shows up. Not a disaster, not a collapse, not some movie-style tragedy. Just a house needing money. The HVAC system breaks. $13,600. His wife's car needs repairs. $2,900. Homeowners insurance goes up. Property taxes rise again. And suddenly, a family that spent 5 years doing the responsible thing cannot comfortably pay for normal adult problems. On paper, Richard is wealthier, but on Friday morning, he does not need equity, an amortization schedule, or the feeling of beating the bank. He needs money. Brian looks less impressive during those same 5 years. His mortgage goes down more slowly. If you compare mortgage balances, Richard is ahead. But Brian has a $42,000 emergency fund. When Brian's family also faces unexpected expenses, he does not sell investments at a bad time. He does not put the repair on a high-interest credit card. He does not open a HELOC in a panic. He simply uses cash that was created for a bad year. This is where many people make the mistake. They think safety means a smaller debt balance, but sometimes safety means money you can use right now. A house can be worth $600,000. You can have $250,000 in equity. Your mortgage balance can be falling faster than scheduled. But if a $13,000 repair sends you into credit card debt, are you really free? Or are you just rich in the house and poor in available money? Reason 3. Extra mortgage payments can steal time, not just interest. Now let's look at Brian. He did not send the full $1,000 to the mortgage. First, he captured the full 401k match. Suppose his employer matches 50% on the first 6% of contributions. For a family earning about $120,000 a year, that can mean several $1,000s a year in additional retirement contributions. This is not market magic. This is employer money. If someone lowers 401k contributions to pay down the mortgage faster, they may be giving up part of their compensation. Vanguard has even pointed to this as a common mistake. People rush to prepay debt, including mortgage debt, and miss retirement matches and future compounding. And here, age matters. A dollar invested at 45 has more time to compound than a dollar invested at 58. If Brian invests $1,000 a month for 15 years and earns a hypothetical 7% annual return, that money could grow to about $317,000. Is that guaranteed? No. The market does not move in a straight line. Some years are ugly. Some years feel like the whole plan is broken. But the number shows the size of the alternative. Richard sends money to the mortgage and gets guaranteed interest savings. Brian sends money into retirement accounts and investments. And he buys potential growth, employer match, and flexibility. So the question is no longer, which is better? The question is, which dollar should be used first? If you already capture the full match, have an emergency fund, and do not have expensive debt, extra mortgage payments can be a strong move. But if you are missing the match, holding a weak cash reserve, and falling behind on retirement savings, you may be sending money to the mortgage too early. Sometimes, a financial mistake does not look like a luxury car, an expensive vacation, or a $40,000 kitchen remodel. Sometimes, it looks like an aggressive attempt to do the right thing. Reason 4. The mortgage tax deduction does not always save you the way people think. Many Americans still say, don't pay off the mortgage too fast. Mortgage interest gives you a tax deduction. Sometimes, yes, but for many middle-class families, that argument is weaker than it sounds. Why? Because most taxpayers use the standard deduction, not itemized deductions. In 2026, the standard deduction for married filing jointly is around $32,200. For mortgage interest to really help, a family has to itemize. That means their deductions have to exceed that threshold. Now imagine a $400,000 mortgage at 6.5%. In the first year, interest may be around $26,000. Add property taxes, maybe $6,000 to... In some cases, that family may be close to itemizing, especially in expensive states with larger mortgages and higher taxes. But it is no longer a universal argument. If someone says, I'm keeping the mortgage for the tax deduction, but they have never checked their real numbers, they may be making a decision based on an old rule that no longer applies to their family. And this is what the viewer needs to understand. Do not build your strategy on phrases that sound smart. Build it on your actual numbers. Do you itemize, or do you take the standard deduction? Does your mortgage interest actually reduce your taxes, or does it just sound like it does? How much are you saving after taxes? And is that savings worth keeping the debt? Or, on the other side, are you paying the mortgage too fast because you never calculated the opportunity cost? Almost everyone gets into trouble when they take one argument and turn it into the whole plan. Reason 5. Retirement needs income, not just a paid, off house. Now let's move forward. Richard is closer to 60. The house is almost paid off. That is a real achievement. It should not be dismissed. A house without a mortgage before retirement can dramatically reduce monthly expenses. If you no longer have a $2,500 mortgage payment, your Social Security and retirement portfolio have less pressure on them. But Richard starts to see the other side. The house is almost paid off, but the retirement account is smaller than it should be. Cash is weak. The 401k is not where he wanted it to be. Healthcare costs are ahead. Property taxes did not disappear. Homeowners insurance did not disappear. And repairs did not disappear. Here is the uncomfortable truth. Even when the mortgage disappears, the house still needs money. Property taxes, insurance, utilities, repairs, roof, HVAC, plumbing, landscaping. A house without a mortgage is not a free house. Brian still has a mortgage balance at 60, and he does not love that. Psychologically, it is uncomfortable to know the bank still receives a payment. But Brian has a portfolio, he has cash, he has retirement accounts, he has the option to make a lump sum payment later if he chooses. He can downsize, he can keep paying the mortgage if the cash flow works. He is not automatically richer in every scenario, but he has more options. And at 60, options can matter more than a beautiful number on a mortgage statement. Retirement with a mortgage can be dangerous, but retirement with a paid-off house and a weak retirement account can also be dangerous. One risk shows up every month as a payment. The other risk hides until it is too late to go back to your 40s and give your money more time to grow. So what should you actually do? This is where many videos give a bad answer. They say always pay off the mortgage. Or they say always invest. But life is more complicated than that. If you have a mortgage around 7%, a fully funded emergency fund, no high interest debt, the full 401k match captured, and retirement savings on track, extra mortgage payments can be a very reasonable decision. If you have a mortgage around 3%, a weak emergency fund, you are not capturing the match. You have credit card debt, and your retirement savings are behind. Aggressive mortgage payoff may be a beautiful but dangerous mistake. Here's the order almost everyone should check. First, do you have an emergency fund covering at least 3 to 6 months of expenses? Second, are you capturing the full 401k match? Third, do you have expensive debts like credit cards, personal loans, or high-rate auto loans? Fourth, what is your mortgage rate? Fifth, how many years do you have until retirement, and how large is your retirement gap? Sixth, if you send every extra dollar into the house, will you still have cash? Only after that does the question, pay off early or invest, become a real question. Before that, it may just be an emotional reaction to a very large debt, and that reaction is understandable. A mortgage is heavy, but financial freedom is not just the absence of debt. Financial freedom is when one bad year does not destroy your life. Richard thought he was buying safety because his mortgage balance was falling faster. Brian thought he was buying freedom because his cash and portfolio were growing. Both were partly right, but the real lesson is not who won. The real lesson is that $1 can buy different kinds of protection. It can reduce debt, it can create liquidity, it can capture an employer match, it can buy compounding time, it can reduce future interest, it can buy peace of mind. The mistake begins when someone buys only one kind of protection and assumes all the risks are covered. Before you send the next $1,000 to your mortgage, do not only ask, how fast can I pay off the house? Ask, if life stops going according to plan, where is my protection? If the answer is only inside the walls of your house, that may not be freedom yet. It may be an expensive version of peace that disappears with the first large bill. Paying off your house early can be one of the best decisions of your life, but only if you are not buying mortgage freedom at the cost of your emergency fund, retirement growth, and real options. Because a truly paid off house is not just a house with no debt. It is a house surrounded by cash, retirement income, and the ability to survive a bad year. That is real freedom.